Hello everyone, this is Bhavik Chokshi over here and I hope you guys are doing great. Today we would be doing a revision for the CA Final SFM topic on portfolio management. This is a tier 1 category chapter and has an assured weightage of around 10 to 15 marks in your exam. Now this is a chapter which has a lot of formulas, a lot of concepts, and the idea over here is to kind of revise those formulas, revise those concepts in a chart form so that you can fairly remember them, and this video can probably help you to refresh as well as revise the day before your exam. So let us get started. So when we are looking at portfolio management, or who is a portfolio manager? Well, a portfolio manager is a hedge fund manager or a mutual fund manager, basically someone who is managing a portfolio, a group of securities. So what does he need to remember while managing this portfolio? Well, we need to balance risk and return. So a portfolio manager, like an equity manager, may want to maximize the return, but that is subjected to a given level of risk. Or a bond manager might want to kind of minimize the risk at a given level of return. So the objectives of a portfolio manager depend on the risk and return. So how does one calculate the risk and how does one calculate the return? So the risk and return first needs to be figured out from the perspective of a single security. So if you have a single security, for example like Reliance, in which you are investing, let us say 1,000 rupees. So what is the return of that security? Well, the investment, that is P0, is 1,000, and the return that you are expecting, the price appreciation that you are expecting, is going up to 1,200. So one can say that 1,200 minus 1,000, that is 200, is a return. But apart from that, a share also gives something like dividend, and as a result, the dividend should also be taken as a part of the return. So we calculate the return as P1, that is a price after a year, minus P0 plus D, that is dividend, upon P0 into 100 if you want to calculate it in the form of percentage. This is the return for a particular year for a particular security. In case instead of a share there is a bond, so there will be interest. If there is a real estate, there can be rent, for example. So anything which is contributing to return will be taken over here. Okay, so this is for a single security. Now before we go to the portfolio concepts, we need to understand risk. What do you mean by risk? Now risk inherently is the uncertainty that a particular investor faces. So I mean, just to give you a lame example, something like 12th standard. One would say that 12th standard में पढ़ाई में कुछ ज़्यादा risk नहीं है. It's not as risky. Why? Because we don't see any uncertainty over there. Compare that with CA Final and you have your answer. Final is risky because there is uncertainty in passing. In a similar way, when we look at securities, what is that item which gives birth to risk? It is the uncertainty, it is the volatility which gives birth to the risk. So how do we measure that uncertainty? How do we measure that volatility? In practice, people use the concept of range as well, that is the 52-week high minus 52-week low, and that can give you the range. However, that focuses on only two observations, and hence we take a slightly more sophisticated measure of risk, which is called as standard deviation. How do you calculate standard deviation? Well, among other things, standard deviation X is calculated as under the root. So this is under the root, summation X minus X bar, the whole squared, divided by n. What does that mean? Well, X bar is nothing but the average return. So X bar is calculated as summation X divided by n, which is the average return. So if nothing is available, one can expect that we are expecting an average return from the security. So in the past 3 years, for example, if the security has given 10%, 20%, 30%, simple average would be 10 plus 20 plus 30 divided by 3, which will give you 20%. So on an average, we expect to earn 20%. However, what is the birth point of risk? The fact that in some of the years you might earn 10, some of the years you might earn 30, and as a result over here we are going to have a volatility. So this is X minus X bar. Why do we square it? Well, because if you don't, the total of all the numbers is going to come to 0, and hence we say that there are X bar is the average, so it is at the center of the population. There are equal values above the mean, equal values below the mean, and hence in order to remove that negative sign, we square it. However, at the end of the day, the returns etc. are not calculated in squared terms, and hence the risk should also not be calculated in squared terms, and hence we square root it. So over here, that is summation X minus X bar, the whole squared, divided by n. All of these workings will apply in case of a situation where you have no probabilities given. If probabilities are given, you will have to alter the formula a little, whereby you would say that if probabilities are given, x bar will equal summation p into x. Remember, whenever you are looking at x bar, you typically divide it by n. However, that is because there is equal weights for every observation. However, whenever there is a probabilities, remember, you should never divide it by n because you're multiplying it by p. And then when you calculate standard deviation x, that can be calculated as under root summation p into x minus x bar the whole squared. Again, you will not divide by n. Remember, across the board, whenever you are using probabilities, you will never divide by n. Okay, so that gives you the risk of a single security. Now you can use these concepts to go into a portfolio setup. So when you try to calculate the portfolio return, well, portfolio will be more than one security. So a portfolio return should be the return considering each of these securities. Let us say I have two securities in my portfolio. One is a Reliance, one is Tata Steel. How do I calculate the portfolio return? Well, I will have to look at the return from both the securities and also the proportion of my investment in both the securities. So the portfolio return will be calculated as the weighted average return, that is the weight of x into the return of x plus the weight of y into the return of y. What will be the weights? Should it be the number of shares? No. Should it be the price per share? No. Then what should it be? Well, it should be the entire amount that is invested in a particular share. That should be taken as weights. Again, a couple of challenges that you have to counter over here is, first, will the amount invested originally continue to remain as the weight for all the subsequent years? The answer is no. The weight should be based on the value of the investment at the beginning of the period. For example, if I were to calculate the return for the second year, the return for the second year will be P2 minus P1 upon D upon P1 into 100. So the return is calculated taking P1, the price at the end of the first year, as the weight, when we are looking at the return for the second year. So if I want to find a portfolio return for the second year, then obviously I will also have to take the weights as the value of the investment at the start of the second year. So over here, that may be number of shares into P1 will be the value of the investment at the start of the second year, and that will be taken as weights. You have to remember that. In a single year question, yes, the amount invested at the start, that is at the beginning, will be taken as weights. However, if you are asked a question where after the first year you separately have to calculate the portfolio return for the second year, then the value of the investment at the start of the second year will be taken as the base for your weights calculation. That is point number one. Point number two is, what happens if there is a short selling? What do you mean by short selling? Well, you are selling something that you don't have. Maybe you can use the advance borrowing and lending mechanism for the same, but that is an operational point. If there is a short selling, how does that affect your calculation of weights? Well, typically the amounts invested are cash outflows. However, when you short sell, you don't really incur a cash outflow. Instead, you get a cash inflow on the selling. So over here, typically you short sell securities which you expect to go down. So over here, let us say you have invested in a security X 100 rupees. You think that X is going to go up, and then there is another security Y which you think is going to go down. So what do? Well, you sell that security now. Maybe use advance borrowing and lending mechanism, but you sell the security now. If you sell, you don't invest money, you don't pay money, in fact you receive money. So over here, maybe you sell this worth 50, and ये जो पैसा extra 50 आपके पास आया, hypothetically let us say you invest that again in security A. So what that results is your total amount invested in security X is 150, whereas Y is a minus 50. So your net will be 100. If I want to find the weights, this is 1.5 and minus 0.5. We typically tend to believe that weights so kabhi negative ho hi nahi sakta, which is usually the case if you have made the investment. However, if you have short sold, remember the weights will be negative. Okay, so this is about short selling and this is about portfolio return. Then going into one of the most important points of this chapter, which is portfolio risk. If I were to rate two things as the most important in this chapter, it would be one, portfolio risk, second, the CAPM concepts. Achha, how do you calculate portfolio risk? Well, ideally, if the return is calculated as weighted average, then the risk should also be calculated as weighted average. That is the weight of X into the standard deviation of X plus the weight of Y into the standard deviation of Y. However, we might have studied a slightly different and a much more complicated formula over here. And why is that? Well, that is because when we look at returns, the returns for security X or a return for security Y can very well be negative. However, the way standard deviation is defined, it will never be negative. So it is summation of x minus x bar the whole squared. So it is squaring. So it will always be positive. Sir, what are you saying? We're not able to follow. For example, let us say your portfolio has two companies. One is Maruti Suzuki and one is Tata Steel. Maruti manufactures steel, Maruti uses the steel, Tata Steel manufactures it. Let us say the prices of both the companies are 100, and let us say there is a change in the steel price. Steel price rises significantly, so that is good for Tata Steel, so its value goes up, so there is a change, and it is bad for Maruti, so its value goes down hypothetically by the same 50 rupees. So if I were to look at the standard deviation, I'm not calculating in the exact ways, but if I were to look at the standard deviation, I would say this is 50, this is also 50, positive. Standard deviation cannot be negative. And as a result, if I were to calculate the weighted average standard deviation, one can say, okay, amount invested was equal at the start of the year. So 0.5 into 50 plus 0.5 into 50, and hence your total would be 50, which is understandable. However, as a matter of fact, if you go to see, the portfolio at the start is 200, the portfolio at the end is also 200, which means as a matter of fact, there is no deviation. So if there is no deviation, then why is my standard deviation for the portfolio coming as 50? It is because I'm assuming that 50 and 50 are both the deviations in the same direction, because the standard deviation is assumed to be positive, and that is the drawback. And hence we need to factor in something called as correlation or covariance, as the case may be. So when we look at the workings, the formula for this would be the weight squared x. So you see this long formula, right? However, this formula is actually a plus b the whole squared formula that you must have studied in school. So that is a squared plus b squared plus 2ab, where a equals weight x, standard deviation x, b equals weight y, standard deviation y. So we can say that this is nothing but a squared, okay, plus b squared, okay, plus 2ab. But when you do ab, that is an interplay of a and b. We don't know whether a and b are going in the same direction, and as a result over here we also incorporate the correlation xy term, because like in the Maruti and Tata Steel example, if they are moving in opposite direction, then the correlation will be negative, and in such a case your risk will be reduced, because the third term will probably turn negative in such a case. And hence in order to incorporate that, we also include correlation in this term. So in the limited time that we have, this is the basic genesis of why we are using this big formula rather than directly using the weighted average formula. Acha, so how do you calculate the correlation? Correlation basically is calculated as a function of something called as covariance. What is covariance? Well, what is variance? If in the standard deviation working, if you don't do this square rooting, the number that you get is called as a variance. This is standard deviation squared. So variance is nothing but summation x minus x bar the whole squared divided by n. Well, x minus x bar is not, the whole squared is nothing but x minus x bar into x minus x bar, and then you divide it by n. Acha. So I mean, I'm trying to give you brief insights into the concepts behind each formula so that you remember them as well and not just mug them up. So what is covariance? Covariance says that, okay, you are looking at the variance of x minus x bar, that is deviation, and again x minus x bar. Instead of doing that, you remove the x minus x bar and do y minus y bar. So covariance is nothing but variance of two securities, covariance, and hence it is x minus x bar into y minus y bar divided by n. This is covariance, x minus x bar into y minus y bar divided by n. Again, if there is a probability, this can be calculated as summation p into x minus x bar into y minus y bar, and you will not divide it by n if you multiply by p. Again, covariance is basically a variance term, so you have to resist the temptation of doing a square root. Typically people end up taking a square root over here. You have to resist the temptation because it is a variance term, not a square rooted term. Okay, so what is covariance? Well, it is a co-movement of two securities. If you were to tie the two securities together and say that you move together, how will they move is what covariance is. Loosely speaking, if you are a CA student and you end up getting 500 marks in your CA final, 500 marks, and you are really happy, you go and bob to your medical and engineering friends, they are clueless. They don't know what 500 is, and they don't even know whether to congratulate you or what. However, if you tell your friends that, well, I've scored around 63% in a CA exam, that will give them perspective. That will really make them congratulate you and probably ask a party from you. In which case, that is the job that correlation does. Covariance is the actual movement. That is like your actual marks. Whereas correlation is how much have you scored out of the total possible marks. So over here in the correlation, that is covariance xy, that is your actual movement. In the denominator, you take standard deviation x, that is x minus x bar the whole squared by n, and y, that is y minus y bar the whole squared divided by n. So basically in the denominator, you take the maximum possible positive movements that are possible, like 800 marks if you were to get. That is in the denominator, and in the numerator, you have 500, and hence, well, you can say that you were correlated with the correct answer around 63% of the times. And that is what correlation does, loosely speaking. Correlation is your actual co-movement, that is covariance, divided by the maximum possible co-movement, that is standard deviation x into standard deviation y. Okay, so these are the measures of co-movement which will be useful for our calculation of standard deviation xy. Now, this is for a 2 security. Now, is it possible that the question can come for 3 securities, 4 securities? Well, 3 securities possible, 4 securities, 5 securities relatively rare. If it lands up in your exam, remember the formula that you will use is a plus b plus c the whole squared, or a plus b plus c plus d the whole squared. That is, for example, if you look for 3 terms, that is a squared plus b squared plus c squared plus 2ab plus 2ac plus 2bc. And that same analogy will go for 4 or 5 securities, so institute is unlikely to ask you for multiple group of securities. Okay, then there is something called as, so this I would rate as important from an exam standpoint, the calculation which is for portfolio risk, and obviously that also involves the co-movement, measures of co-movement. Now there is theory of dominance, not really important. Naam sun ke bada lagta hai, theory, dominance, not really important. What is the theory of dominance? Well, if there is a group of securities, does one security dominate the other? Sir, how do we say that? Well, you compare the risk and return. If there is a security which gives a higher return but at the same risk, it is, jisko apan bolte no-brainer, it is definitely better than the other securities, it dominates. Or there's a security which gives you a lower risk but at the same level of return, it is clearly going to dominate the other security. Or the best case, where a security gives you a higher return but at a lower risk. So in such a case, between the 2 securities, you will select only that security which is the dominant one. Not really important. Again, minimum variance portfolio, well, not really as important. What does a minimum variance portfolio mean? Well, in case of a minimum variance portfolio, you will try to calculate the weights that should be allotted in a 2 security portfolio such that the portfolio risk is the minimum. Again, the weights to be allotted in a 2 security setup where the weights are minimum. So over here, the formula over here is, if there were 2 securities x and y, if I were to find the weight of x, I will take the variance of y. I will take the variance of y. Okay, this is the catch point for calculating the weight of x. I will take the standard deviation squared of y, and then everything else minus the covariance of xy upon variance of x plus the variance of y minus 2 times covariance xy. So you can just remember this formula. I mean, loosely speaking, what it's trying to say is, if I look at the weight of x, I will look at the risk that y bears. If y is very risky, then let's keep less in y, keep more in x, and hence you take y as the base for calculating the weight of x. Again, you subtract covariance, loosely speaking, because you are saying that, okay, y has some of its risk, a part of its risk is can be cut out by the co-movements between the 2 securities. What is the individual risk of y? If y is very risky, you give more weight to x and vice versa. Once you find the weight of x, obviously the weight of y is 1 minus the weight of x. Okay, so that kind of takes care of this. This formula can also be sometimes referred to as the Markowitz formula for calculating the standard deviation. Okay, so that is about the first part of portfolio. Second goes to CAPM, which is developed by a gentleman called as William Sharpe in the 1960s. One of the most frequently used formulas in the world of finance. CAPM, as you would be aware, calculates the expected or required return, that is KE, equals to RF plus RM minus RF into beta. So this is the CAPM formula. And what does Sharpe considers in this formula? Well, he does not go by the theory which was in existence earlier, which says higher the risk, higher the return. Well, Sharpe agrees that higher the risk, higher the return, but he does not agree with the fact that any risk is risk. He says the risks have to be subdivided into two parts. There is something called a systematic risk, and then there is something called as unsystematic risk. What is systematic risk? Systematic risk is a risk that you bear by the mere fact that you invest in the equity market. No matter how well diversified you are, the fact that equity is risky, you bear that risk. For example, a few days back, there was a war which Russia declared on Ukraine. On the date when Russia invaded, the Sensex fell by around 2,900 points. Each and every share on the BSE 30 or the national Nifty 50 was down. So no matter how well you are diversified, such an event is something which is the risk of an equity market. So that is a systematic factor, basically a non-diversifiable factor. An unsystematic factor, on the other hand, is a factor for which if you are well diversified, the risk can be managed. So for example, when Steve Jobs died in 2011, Apple share price actually fell. But in the quarter later, if you go to see, in that same time, shares of Google, Microsoft, Samsung, etc. kind of increased because they felt that, well, without Steve Jobs, Apple will lose its innovation edge, which eventually did not happen, but nevertheless. So if you are holding a well-diversified portfolio, an unsystematic factor like a death of a particular CEO or a strike of a company, etc., will not really affect your overall portfolio return, and hence you should not expect compensation for bearing unsystematic risk, though you should expect a compensation for bearing systematic risk. And hence William Sharpe says that you should be getting compensation for bearing systematic risk only, and hence he tries to measure systematic risk in the form of beta, and hence the working over here includes beta. Okay, so how does Sharpe construct a CAPM? He says that, well, we are looking at the minimum required rate of return. If someone comes to us with an investment opportunity, the first thing that crosses our mind, even subconsciously, is this investment giving me at least equal to the risk-free rate, like a government security, or in a layman's terms, bank fixed deposit rate? If not, I don't even consider that. So my minimum required return has to be at least the risk-free rate. उससे ज़्यादा होना चाहिए, उससे कम possible ही नहीं. So it is RF plus something. RF is a risk-free rate of a comparable government security. Achha, now I am going from the risk-free scenario to the risky scenario, where the proxy, for example, for the equity market can be an index. For example, if I'm investing in India, the Nifty 50, if I'm investing in the US, the FTSE 100, if I'm investing in Japan, the Nikkei, or if I'm investing in the US, let's say S&P 500, etc. So I'm going to take a proxy, and I would say that, well, what is the return that an equity market in a particular country is giving? For example, it is giving 15%. So over here, the risk-free rate was 10. For example, the market gives a return of 15%. So can we say that the market gives 15 for bearing risk? No. Market gives 15, 10 तो अपन ऐसे भी कमा लेते थे. The additional 5 is due to the risk taken. 10 तो we would have earned in any case, and hence we are saying that for investing in the equity market, we have a 5% extra risk premium into beta. What is beta? Beta is the sensitivity of a particular share to the movement in the overall market. So for example, if you look at a company like Maruti, Maruti is a company which is a high beta company because it buys and it sells cars. So people, when an economy is really good, are going to buy more cars, but if it's bad, that is the first thing that they are going to cut down on. On the other hand, Colgate, for example, sells toothpaste. Now, whether the economy is good or bad, you're not going to consume more or less of toothpaste, right? And hence the beta is relatively low. So when we are looking at beta, for example, for Maruti, which is 2 times, we are saying that, okay, if I were to put my money in Nifty 50, the National Stock Exchange 50, then I would have got 5% more than the risk-free rate. I'm investing in a company which is 2 times as risky, and as a result, I should get 15 minus 10, that is 5 into 2 extra, and hence the required rate of return, for example, is 20% over here. This is how Sharpe goes around. Now for this, you need to know RF, RM will typically be given to you in the question. In practice, you can look at it from the RBI website or the BSE or NSE website. However, when we look at beta, how do you find beta? What is beta? Beta refers to the responsiveness of a security's return vis-a-vis the market's return. And there are two ways in which you can calculate the beta. First of which would be beta is calculated as a correlation of the, okay, let me build this formula up rather than just discussing. So over here, beta, if you go to see standard deviation, you must have seen around 30, 35, 20, but beta you see around 1, 1.5, 0.5. So does that mean that out of the 30% risks that we are bearing and in the form of standard deviation, only 1.5 is systematic? No. Beta is a relative factor. When I say relative, it means it shows you the risk relative to that of the market. So for example, your security has a 30% standard deviation. Market is not risk-free. Market will also have a standard deviation. So we will say that how much is the standard deviation of the market? Well, the market standard deviation is 15% and hence your beta is 2 times. That is, you are 2 times as risky as the market. That does not mean that your risk is only 2. No, it is 2 times the market. Okay. Excellent. However, where have you considered the systematic and unsystematic factors? Well, Sharp believes that the market is well diversified and hence market essentially has systematic risk only. Unsystematic risk, if any, has been diversified in a wide portfolio. Let us say if the market is S&P 500. So S&P 500 is 500 shares, which is a very diversified portfolio. So unsystematic risk, if any, has been eliminated or significantly reduced. However, your security is an individual security and hence your security still has unsystematic risk. So when I do standard deviation, I do X minus X bar. Whether that X deviates from X bar because of a systematic event like war happening or it deviates from X bar because of my CEO's death, it will be captured in that 30% and hence that 30% includes both systematic and unsystematic risk. However, William Sharp believes that in moments, in times, in instances where you have moved in tandem with the market, Sharp believes that the market moves only due to systematic factors. So in scenarios where you have moved in tandem with the market, those are the times where your movement was systematic, other times your movement was unsystematic, and hence Sharp says that okay, let us try to find the correlation of your security with the market, which for example is 0.7, in which case we can say that okay, 21% of your deviation was due to the systematic factor, the remaining, loosely speaking, 9% may be due to unsystematic factor, and hence this is 21 upon 15, which will give you your coveted beta, which is a very, very important number, which I guess is 1.4 over here. Acha, the second formula, so this is the first formula. The second formula is kind of a derivation of the first formula. So if you kind of in the first formula open up the correlation term, so this is covariance of S and the market upon standard deviation of S into the standard deviation of M into standard deviation S upon standard deviation M. I'm just opening this up, so this gets cancelled and hence you have covariance upon the variance of the market. So the second formula is kind of a derivation of the first formula only. Acha. In fact, as we will proceed further, we will see that the numerator of beta calculation, the numerator that you see of beta, that is R into standard deviation S, is basically systematic risk. So when I look at beta, beta is correlation into the standard deviation of security upon the standard deviation of market. Denominator mein is the systematic risk or the total risk of the market. In the numerator, you have the systematic risk of the security. So one of the ways in which you can calculate the systematic risk is the correlation of the security into the standard deviation of the security. You will see over here that we have done it in square terms. As a reason for that, very mathematical, but nevertheless we'll just kind of touch upon that. So this is the numerator of beta. Another formula, I mean, beta is the systematic risk of the security upon the systematic risk of the market, and hence the numerator is the systematic risk of the security. So you should remember that your systematic risk is not 1.5 or so, it is 1.5 into 1.5 is the beta. So it is like if I rearrange this, you will understand what I'm trying to refer. If I rearrange this and if I take the standard deviation M on the other side, this will be beta into standard deviation M equals R into standard deviation S. So over here, both of them are equal. So my risk is not 1.5 or my risk is not just 1.4, it is 1.4 into 15. And hence 21 is my systematic risk. It is just that it is 1.4 times the market. And as a result, we have this formula through which you can calculate systematic risk, okay, which is beta squared of the security into variance of the market. You have to play around the beta formula only. The only thing you have to remember over here is when institute asks you to calculate systematic risk, in almost every question they've also asked you to calculate the unsystematic risk, and unsystematic risk is basically the balancing figure. So if you look at your total risk is the systematic risk plus the unsystematic risk. Total risk is calculated through standard deviation, systematic risk is calculated through the numerator of beta, and hence the unsystematic risk should be the balancing figure. Now whenever unsystematic risk is to be calculated, we have to ensure, and we don't have as much time to discuss the deep concepts on this, but we have to ensure that the calculation is to be for both total as well as systematic risk is to be done on a squared basis only. So the unsystematic risk that you get, jisko bolte hain error term squared, that is unsystematic risk will also be in squared terms. Sir, what is the reason? In short, if I were to explain something that you have done in school, 25 is equal to 9 plus 16. Sir, kya padha rahe ho? Acha, if I take square root on both sides, it is square root of 25 equals the square root of entirely 9 plus 16. So answer sahi aayega. However, if I take the square root of 25 and I say, okay, let me take the square root of 9 and then separately take the square root of 16, to nahi chalega. Your answers will not tally. So 5 will not equal 3 plus 4. Answer galat aayega. This is the right working. Sir, concept tangent pe ja raha hai. 25 is like the variance. 25 over here is like the standard deviation squared. 9 over here is like the systematic risk squared, and 16 over here will be the unsystematic risk in squared terms. If I take the square root of 25 and get the standard deviation, that is 5, if I take the square root of systematic risk and get the number 3, I will wrongly assume that the balancing figure over here is 2, which is not the unsystematic risk. समझ में आता तो ठीक है, otherwise just remember, long story short, unsystematic risk will be calculated as a balancing figure from total and systematic. However, it will be done in squared terms. Okay, now there are a few lines which are studied in this chapter. There is something called a securities market line, whereby you study your return, your percentage return with risk, that is beta. Capital market line, where you study the percentage return with standard deviation. So when you prepare a chart, you would take, for example, the return percentage on one axis and beta on the other axis. You will take, for example, the return percentage on one axis and the standard deviation on the other axis. So what is securities market line? It is nothing but the graphical plotting of the CAPM. So whatever is CAPM, usko agar apan graph pe plot kare, so you will get the securities market line. Not very important from an exam standpoint. What is CML, capital market line? It is a graphical plotting of the expected return if standard deviation were to be taken as a risk factor and not beta. Acha, again, higher the risk, higher the return, so both of these lines will slope upwards. You are not going to be asked to make graphs in general, but nevertheless. Acha, then you have something called as characteristic line. This is important from an exam perspective, not for graphs, but for the equations and the formula. Characteristic line at the end of the day is the equation of a line only. It is the equation of a line only, that is x equals alpha plus beta m. There is a derivation for that, but I'm not going into a derivation at this point. This is the equation of line that you must have studied in school, that is x is equal to a plus b y. That is exactly the same. You just have to remember that where alpha equals x bar minus beta m bar. So this is x bar remains constant for all observations, beta remains constant for all observations in the data, m bar will remain constant for all observations. So that alpha term will remain constant. Then as m is substituted, we can find x. What is the ultimate objective of a characteristic line? It is to kind of track the characteristic or the quality of beta. Actually, अगर अपन देखें तो अपन मानते हैं कि भाई if beta is 2, that means whatever is the movement in the market, your movement should be 2 times. But in practice, that is not going to always happen. So what we will do is we will say that okay, let us try to draw a line based on this equation, and let us plot the points, actual points. If these points come close to the line, we will say that okay, the beta's quality is appearing to be good. But if they are very far dispersed, we would say that by line ने जो predict किया था, उसके सामने actual results are something else, only beta is not of a good quality. This is just for your understanding. Achha, so this is the characteristic line. Among the three lines, I would say from an exam standpoint, characteristic line is a line which is slightly more important. And then comes the concept of portfolio beta. Like we've studied the portfolio standard deviation, the portfolio return, you have the portfolio beta, which is calculated as a weighted average beta. Not like that big formula. Sir, why? Because standard deviation cannot be negative. It will be positive, but return can be negative. In a similar way, beta also can be negative, and as a result, when we calculate the portfolio beta, it is calculated as a weighted average beta, where weight of x into the beta of x plus the weight of y into beta of y. In any case, when you calculate the beta, correlation will be factored in, correlation of x with the market into standard deviation of x upon standard deviation of m. It is already a part of beta, so you don't need to separately take the correlation. Unsystematic risk, if any, could have been reduced. Systematic risk cannot be eliminated. So, आप कितना भी बड़ा portfolio बनाओ, the beta of the portfolio will be the weighted average beta. Okay, so this largely takes care of these workings. But before we go there, I'll just try to touch upon two important things. First is the various methods through which covariance can be calculated, and I mean, we have not really noted that down separately, but covariance can be calculated as, I'm assuming it is, there's no probabilities given. So this is summation of x minus x bar into y minus y bar divided by n, the traditional formula. Other is through adjusting that covariance formula. One can say that, okay, covariance upon standard deviation x into standard deviation y is the correlation. So basically correlation of xy into standard deviation x into standard deviation y can also be taken as one of the ways to calculate covariance. And lastly, one formula which is not as frequently used but you should be aware is beta x into beta y into the variance of the market, standard deviation squared of the market. This is helpful to calculate covariance in cases where betas are given but other items are not available to calculate covariance. So this is one thing that you have to remember in your armory just in case it comes. Also, for calculating portfolio risk, this is one method which is possible, which is almost done in almost every question, which is like the Markowitz method. There is also another method to calculate portfolio total risk, which is like the systematic plus unsystematic. This is also called as the Sharpe index model. So in the Sharpe index model, you calculate the portfolio risk of, let us say, I'm just taking it in square terms so that I don't have to put the square root, is calculated as the beta xy into variance of the market. So over here, this is like the systematic risk of the portfolio beta into variance of the market plus the unsystematic risk. So this is weight of x squared into the unsystematic risk of x plus the weight of y into the unsystematic risk of y. Again, this is rarely used. However, in case it is asked or in case the data requires, you should remember that there is a formula like this which also exists, which will give you exactly the same answer as the above formula. If you want to find the standard deviation, then you will square root this entire term, and in that means you will get the standard deviation. So basically, this is a systematic risk of the portfolio and this is unsystematic risk of every security in the portfolio. You also have to remember that there is something called as random error. Sometimes institute asks you random error. Random error is nothing but unsystematic risk square root. So if there is a unsystematic risk square rooted, that is also called as the random error term. Okay, so that takes care of the more important parts of portfolio. There are a few other parts of portfolio which probably have some application in mutual fund chapter as well, though not as important. Performance evaluation measures. Acha, there are 3 performance evaluation measures that we study. If I have 10 mutual fund managers in front of me and I have to select the best ones, how will I do that? Well, there are 3 ratios that you can use. First, there is the Sharpe's ratio, the Trenner ratio, and Jensen's alpha. All the 3 ratios we can remember, higher the better. All the 3 ratios, higher the better. Achha, there is a very strong possibility that you go wrong in these ratios if you don't understand the concept. Achha, Sharpe ratio and Trenner ratio, both of them are reward to risk ratios, which means in the numerator of the Sharpe ratio, you will take the reward, which means if I were to invest in a fund manager, how much fund manager X, how much actual return, not required return, how much actual return has a fund manager earned. For example, a fund manager has earned 15%. Achha, what was the risk-free rate? well, it was 5%, which means even if the fund manager was not there, I could have invested in the risk-free security and I could have still earned 10%. So 10% was the reward that we got for bearing the risk of investing in risky assets. Achha, but that is the reward in the numerator, which is the same over here as well. This is 15% minus 5%. In the denominator, you take the risk. So these are like the reward to risk ratios. Achha, risk kya hoga? Well, risk can be of two types. It can either be beta, it can be standard deviation. If you have not understood the concept, you will intuitively say कि Sharp and Trenner उसमें से beta किसके denominator में आएगा? Well, Sharp invented beta, and hence we would by default assume that beta will come in the calculation of Sharp ratio, which is wrong. Sharp over here takes a U-turn and says that, well, if I'm doing performance evaluation, it has to be taking standard deviation in the denominator, whereas Trenner says it has to be taking beta in the denominator. Sir, why? Well, Sharp says that till now we were assuming that the investor is rational, well diversified, efficient. If the investor is well diversified, then the unsystematic risk will be eliminated. However, if he is not, then unsystematic risk will still be there. So if I'm evaluating fund managers, I should not presume that these fund managers are well diversified and they're efficient. I should evaluate them, and hence I should take the total risk in the denominator. That is to say that if the fund manager is well diversified, there would be no unsystematic risk, and hence the standard deviation X will be very close to the systematic risk only. However, if a fund manager is poorly diversified, then that standard deviation will be higher, and as a result, well, the fund manager should be penalized because he is not well diversified, and hence Sharp takes standard deviation in the denominator to catch hold of undiversified fund managers as well. Trenner over here kind of assumes that the fund managers would be well diversified and hence takes beta in the working. Then the third number over here is like the alpha. We also studied alpha in the characteristic line. Well, in the exam, if you are asked Jensen's alpha, then you will take this. Otherwise, or you are asked alpha as per characteristic line, it was the other formula. Achha, over here, you calculate the actual or the forecasted return of a manager and compare it with KE, which is the required return. This is calculated using CAPM, whereas this actual return can be calculated using summation P into X, or basically X bar. So this is like your X bar, and hence you're comparing the actual return with what is required. The mark of a good fund manager is that the fund manager will earn a higher return than what is required, and that is when he has pinpointed, identified the good securities. So that is performance evaluation measures, all the three, higher the better. The next theory over here is like an arbitrage pricing theory, also called as a multi-factor model. What is the arbitrage pricing theory? Well, this originates from the drawbacks of CAPM. So CAPM does the working only based on a single factor, that is the market. So William Sharp assumes that every macroeconomic event has to have an impact on the market. So if there is a macroeconomic event like a change in the exchange rate or changes in oil prices, they will be factored into the market, and hence they should be affecting your required return. However, the proponents of arbitrage pricing theory say that why should every macroeconomic factor have a bearing on each company? For example, if I'm a coaching institute, let us say I'm listed, how does it matter to me if the exchange rate changes? Because all my customers or students are Indians, all my faculties or expenses are also based in Indian rupees. So how does it even matter whether the exchange rate changes or whether oil price changes? However, for a company like Infosys or TCS, it does matter because a lot of their export earnings are in dollars. So over here, rather than relying on only one factor, that is the market, we will identify the core factors that will affect the return of your company. And hence over here, while we use the same formula, that is K is equal to RF, we take multiple factors, 1, 2, 3, dot, 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 and it is open-ended. It depends on your company कि भाई आपको कौन से factors लेने हैं. So over here, you take lambda of factor 1 into beta of factor 1. So what do you mean by lambda? Lambda is like that same, like we do RM minus RF into beta. Lambda is the same thing. So instead of taking RM, you are taking probably the return of dollar minus the risk-free rate. Over here, if oil is an important factor, you are taking return that oil gave minus the risk-free rate, etc. So So we are not just taking the market. Market may be one of the factors, but it is not the only factor in the CAPM, in the arbitrage pricing theory. So theory wise, this appears to be a very good theory, but in practice it is rarely used because of the open-endedness, because of the ambiguity on the selection of the factors, and hence CAPM still rules supreme in practice as well as in your exams. So the lambda over here can be calculated as the risk or the return of factor 1 minus the risk-free rate. In certain cases, people like Stephen Ross have suggested that what moves a particular security is not the factor itself but the surprise element. So you must have seen that in certain cases companies have or India for example has a very high GDP, for example 7 or 8%. Now that is, I mean, bearing China, there's no economy that even comes close to India in that respect. However, if our GDP growth, which was expected at 8, if it comes to 6, the market will come down drastically. But well, 6 is still higher than majority of the countries of the globe. Stephen Ross says that ideally the premium that should be considered should be based on the surprise element, that is how much was the actual and how much was expected. Uske beech mein ka jo difference hai should actually move the prices, and hence an alternative way to calculate lambda would be to compare the actual and the expected. But sir, how will we know in the exam which of the two should we take? Well, it depends on the data. If you have been given actual and expected data, then you can use the second formula. Otherwise, in all other cases, you can use the first formula. Risk-free rate will in any case will always be given in every question, and the actual return of the factor, if that is available, you can always take the first formula. Acha. Next, we have private company valuation. A part of this is covered in corporate valuation chapter of your study material, like fund evaluation is covered in the mutual fund chapter. A part of this is covered in the corporate valuation, but we'll touch upon that here as well. Why do you want to do private company valuation over here? Well, let us say there are two companies. One is Britannia, which is listed. One is Parle, which is unlisted. You want to find the value of Parle. How do we find the value? Well, we will probably try to find the value as the present value of the future cash flows that Parle can generate. Well, you forecast the cash flows. However, when you go to discount it, you want to find the cost of equity. But in order to find the cost of equity, you need the prices of Parle. The fact that Parle is unlisted, you don't have those prices. And as a result, you hit a roadblock. How do you calculate the required rate of return? And hence, in such cases, in order to calculate the appropriate discounting factor for a company in a particular industry, we will use these techniques. So for private company valuation, you will first try to find a proxy company, or you will take an industry average as the case may be. So for example, in Parle, that can be Britannia, let us say. So you will find a proxy company. Now Britannia is listed, Parle is not, but Britannia is. So I can actually look at the share prices of Britannia, and based on that, I can find the beta of Britannia. So over here, I will find the equity beta for the proxy company, that is Britannia. Now, Britannia bears the risk of the biscuit industry, which Parle also bears, but Britannia might have a lot of debt, financial risk, which Parle may not necessarily bear. So the equity shareholders of Britannia bear the operating risk of Britannia, that is the risk of the biscuit industry, as well as the financial risk. That is its ability or inability to service its loan. So over here we try to find the asset beta, or what you call as the unlevered or the ungeared beta. So the asset beta would be calculated in almost the same way as a WACC is calculated, the weighted average cost of capital, where when you calculate WACC, you calculate this as the cost of debt into debt upon debt plus equity plus the cost of equity into equity upon debt plus equity. This is for the enterprise as a whole. So I'm saying forget only equity shareholders of Britannia. What is the risk or what is the sensitivity of all the assets of Britannia? So over here, instead of taking the WACC, I take the beta assets. Instead of taking the cost of debt, I take the beta of debt, and instead of taking the cost of equity, I take the beta of equity. Typically, if nothing is given, the beta of debt is assumed to be 0. Because if Britannia has taken a loan, the value of the loan does not change if the market changes. So the sensitivity is kind of 0. And as a result, beta debt, unless given otherwise, will be 0. And if that is 0, beta assets will equal beta equity into equity upon debt plus equity. This is provided the tax rate is not given. In a WACC, if the tax rate is given, we typically adjust it as interest into 1 minus t. Here, the tax adjustment is not done, and hence in line with the institute solutions, this is debatable, but in line with the institute solutions for consistency as well. So we will take d into 1 minus t. So we say that the debt is, we get tax savings, and that is it. So this will give you asset beta, unlevered beta, asset beta as the case may be, for all the equity, for all the assets. So this is the operating risk of Britannia, ignoring the debt and equity structure. Does Parle also bear that risk? Of course. However, Parle shareholders bear the operating risk of the biscuit industry, but at the same time, if Parle also has debt, Parle shareholders will also bear the risk that Parle is unable to pay. And as a result, over here, we calculate asset beta for the proxy company. Like over here, we calculate for Britannia. Based on that, we find the beta of the assets of Britannia, that is a biscuit business. However, we want to find use CAPM, for which we need our equity beta. Like Britannia might have a 3:1 debt to equity, but we might also have a 1:1 debt to equity or a 2:1 debt to equity. So yes, our shareholders will also be bearing financial risk, though not as high as that of Britannia. So in this case, let us say the asset beta, ultimately after doing all of these workings, the asset beta comes to 0.94. We would say, okay, our equity beta, we will use the same formula. We will say that for Parle, also the equity beta should be 0.4. हमें पता नहीं है, asset beta should be 0.4. हमें पता नहीं equity beta कितना होगा. We will take the debt to equity of Parle, for example, which is debt to equity 2:1. So we will say, okay, 1 upon 2 is the debt. Let's say tax rate नहीं दिया है, plus 1, and hence you will rearrange and you will find the equity beta for Parle. You see a different formula over here and you get scared about it. Having said that, this is nothing but a rearrangement of that same formula. So over here, if I look at this formula and if I were to, so this is a formula which I would have taken based on the proxy company. However, this is geared beta or equity beta, for which I will take our own company, debt to equity ratio. So if I look at this formula, and in this formula, if I take this thing over here in the numerator and E over here in the denominator, you will get the beta equity working. Beta equity is the unlevered beta into, ये देखो आपको ये numerator में आ गया, and E comes in the denominator. And once you find that equity beta, over here you would look at the debt to equity of the proxy company, whereas from step 3 you will look at the debt to equity of our own company. And once you find that, you can use it into the CAPM. And the last part of this chapter, though I would not really rate this as important, is the Sharpe's optimal portfolio. This is like the grand finale and involves a lot of mathematical calculations. Thankfully, the institute has never asked this, but there is a sum in the study material, so we have to touch upon it and we have solved it as well. So I'm just kind of giving you a overall glimpse, though unless you calculate this, ये आपको समझना next to impossible है. But if you have not, nothing to worry. You can just kind of glance through that, remember the steps and proceed. Exam में अब तक कभी आया नहीं है, and hence it is not as important. But institute का कोई भरोसा नहीं. So what is the Sharpe's optimal portfolio? It is the grand finale. Now people tell Sharpe that okay, you have suggested all of these. At the end of it, you tell us which security should we select. If we have a universe of around 15 shares, which of those 15 shares should you select? Okay, so Sharpe gives you a formula to do that, and let us say Sharpe says that out of these 15, ये 4 share आपको select करना है. Okay, you have done that. Thank you, Mr. Sharpe. In what proportion should we hold those 4 shares? So Sharpe also gives you the optimum weight. Sir, तो फिर काम खत्म हो गया. Well, if world functions as per Sharpe, that is the most optimal portfolio, but it is not necessary that the entire world functions as per Sharpe. So in practice, this can be a good starting point, though this will not always be the most ideal portfolio for every investor. So the Sharpe's optimal portfolio over here, you will first have to identify the securities that you have. For example, the question will give you 7 securities. So in each of the securities, you will now calculate the Trenner's ratio, not the Sharpe ratio. Sharpe बोलता है कि भाई मैं आपको portfolio ऐसा ही बना के दूंगा, which is diversified. So you can look at the performance of each securities as RX minus RF upon beta. So that will give you the reward to risk ratio, which is there for each of the securities. Obviously Turner ratio higher the better, and hence once you have done that, you will rank the securities in the descending order of the Turner ratio, which means the highest will come first, the lowest will come last. Acha, once you do that, comes a very complex calculation of the cutoff point. So how do you calculate cutoff point? You will rank these securities in a particular order and then calculate cutoff point for each of the securities. Acha, cutoff point is calculated using this nightmarish formula, which is the variance of the market into the cumulative of Rx minus Rf upon the unsystematic, easy error term, unsystematic risk squared into beta upon 1 plus variance of the market into cumulative of beta squared upon the unsystematic risk. Even if I have read it wrong, आपको समझेगा नहीं वैसा formula. You will have to practice it once. Mainly, you will have to do a table in order to calculate these two cumulative values. And once you can find these two cumulative values, you can substitute this in the equation in order to find the cutoff point at each levels. Acha, once you find the cutoff points for each of those 7 securities, you will look at the trend of the cutoff points. Typically, they will form a bell shape. They will have to form a bell shape. They will reach a peak and then they will go down. So at the top over here is the point where you will select the security. So if at the fourth security the cutoff point is a maximum, that means securities 1, 2, 3 and 4 should be selected in your portfolio. So this is how you select all the securities up to the maximum cutoff point. Achha, this is about cutoff point, and then there is weights. Once you have selected these 4 securities, how much weight should you allocate to each of them? Well, Sharpe gives a separate working. He says that the weight that is to be allocated to each of the security, let us say only 2 of them are selected, then the weight of X equals to the Z value of X plus the Z value of X and the Z value of Y, assuming only 2 securities were selected. यहाँ तक अपन अभी ट्यून ऑफ हो चुके हैं, but nevertheless, just in case you are still surviving, the Z value can be calculated as the beta value of X upon the unsystematic risk into the reward to risk ratio of that actual security minus the final cutoff point जो आपने select किया था यहाँ पे. For the timing, I mean, we don't really have as much time, and maybe just a cost benefit analysis kare, the reason also to explain that in a lot more detail. Probably that is a topic for a separate video, but this will give you the weights. Just in case it comes, you can try practicing that 1 or 2 questions that are there, and do not really spend a lot of time behind this. Having said that, in this chapter, please do invest time behind portfolio risk, invest time behind portfolio beta, invest time behind the entire CAPM based workings, maybe it is systematic or unsystematic risk calculation, characteristic line, etc. So that takes care of this revision video for portfolio. I hope you have enjoyed the video, and if you have, I would request you to hit the like button and subscribe to our channel as well. We'll come up with more videos, and thank you very much for your time and wish you all the very best. Bye bye, take care. If you do have any feedback on the video, please feel free to share with us, and please let us know your views. Okay, thank you very much. Goodbye, take care.